Well, hi and welcome. My name is Casey Boland. I'm a wealth advisor with HCM Wealth Advisors. I'm joined today by Doug Johnson, who's our senior investment strategist, and Dan Rinck, who's a research analyst with HCM Wealth Advisors and CPAs. Welcome to our webinar. If you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have an opportunity to submit your question, and we'll do our best to answer at the end of our webinar. What a crazy couple weeks it has been for the stock market. So Doug, let's get to it. Let's go to the next slide already, even though I'm going to sit on this slide for a while because this really paints the image and scene of what was going on a couple weeks ago. So let's paint the scene. 2.5 weeks ago, Monday, August 5th. This is almost like one of those movies that you're watching where the movie's opening scene starts with complete chaos. You have no context as to what's going on, but the movie has action and the characters are highly emotional and out of control. This is kind of like one of the surreal moments that occurred on Monday, August 5th. So when you just came off a weekend of beautiful weather, time with family, only to wake up to chaos in the stock market on Monday morning. And you hear the Japanese stock market's down 12%, the second largest drop in its history. And then you're seeing the headlines at the end of the day in the US stock market. It's the stock market's plunged, it's tumbled, it's crashed. There's a global meltdown, a global gut punch. Markets give off a black market vibe as stocks tank, this typical media sensationalism. And, but the words that kept popping up in the media are right here in the screen. It left many people scratching their heads saying, what's a yen carry trade? Well, it was pointed to as the potential culprit of this market downturn. So bear with me. I debated, like, am I going to try to explain this or not? Bear with me. I'm going to try to take 60 seconds and explain a yen carry trade. So a carry trade is a tactic in which an investor borrows a currency with lower interest rates and invests the proceeds in a higher yielding asset, often in a different market with higher interest rates. So Japan's interest rate had been 0% or actually below zero for the last 17 years. And on July 31st, they raised the rate up to 0.25%. And while the US Fed's fund rate has been at about 5 to 5.25%. So over the past few years, there's been many funds that have been using a strategy by buying US equities or selling US bonds with money borrowed from the yen because of this huge disparity in interest rates between the US and Japan. Japan kept the yen cheap on purpose because its economy is primarily export driven. It's had a lot of issues with their economy and market for a long time. And the low price of Japanese products kept exports thriving. And as the dollar has been this dominant global currency, it's remained impressively strong through thick and thin. So this was all fun and profits for a long time. As Japan, you could raise, as interest rates went up, though, for the first time in 17 years, then suddenly the yen wasn't as cheap as it had been. And at the exact same time, the US is expected to start cutting rates, maybe now coming up in September, which means the dollar would become less valuable, completely throwing this international carry trade out of balance. So suddenly you've got a lot of investors that it's been a lucrative trade. They're on margin. They've been maximizing profits, but now they need to sell. And the selling further increased downward pressure. You get into this vicious cycle because selling causes more pressure, so you have to sell more. So you had this vicious cycle where the market ended up down 12% in Japan and really caused problems in the US markets as well and around the globe. So, all right, that was a mouthful. I'm going to hear it from these two afterward about my explanation. But anyway, so let's pause for a moment. Earlier, I gave a movie analogy where the first scene starts with a lot of excitement, chaos. Now, think of this yen carry trade as that chaos and excitement. Now, like in the movies, let's rewind to an earlier time in the story before all the chaos happened. So we're going to go to the next chart here. Let's rewind back to mid-July. What was happening in mid-July? Imagine you're looking out over an ocean view. The sun is shining. There's a light breeze. The water is extremely calm. The stock market is at an all-time high. And as an investor, we've experienced very little volatility. The slide we're looking at shows dot plots of every trading day of the S&P 500 dating back to 2020. And the dates represent the percentage movement for every day. So you can look at the bottom of the chart and all those movements in stock prices, they're represented by dots in 2024. They're in this tight clustered band together. You've got very little movement to the right, which is a move up in stock prices, and very little to the left in down days in the S&P. And there's this one outlier to the right. That's back in February. Stock prices moved up more than 2% on that day. But the tight clustering of the dots representing stock prices this year, it's not normal. There's very little volatility, and volatility is normal in the stock market. You can't have a market that just slowly grinds up all the time and has very little downside, which would be nice, but that's just not the norm. So the environment had been very calm through mid-July. Then we started to have a little bit of a build. So in a couple days span, you had a report showing manufacturing activity fell in July, and employment, the report that was weaker than expected. Tech stocks were starting to come a little bit under pressure after a huge run up. Then Monday, this big yen trade unwind happened. So you put all those pieces together. Monday really was the match that really added to the tinder, and it sent the volatility climbing. So let's continue discussions about volatility. So we're going to go to the next chart. And this particular table shows how many times the S&P has dropped greater than 5% since dating back to 2009. And in fact, I counted them. There's 29 times on this table. And so, in the course of 15 years, that means on average twice per year, you're getting a 5% decline in the market in the S&P. And the bottom of the chart, the low was at 879, and the high was right around 5670 at the top. So that's a healthy return, all while experiencing bouts of volatility along the way. And now the market is now within 1 to 2% of its all-time high again. So it's amazing how quickly this bounced back. All right, we need to talk about volatility, though, a bit more, because that really was the scary element of what happened with this move in the market. And so moving to the next slide now, you'll see this chart that's coming up. It's called the VIX. The VIX is basically a level of volatility in the stock market that's measured, and it's what the expectations of volatility is going to be coming up in the future for a period of time. The VIX has been around, you can see on this chart, since around 1993, January 93, I believe. And on Monday, August 5th, the VIX peaked at a level over 65. I mean, that's the third highest spike in the VIX in the history. And that spike happened in 2 trading days. 2 trading days. That's crazy. I mean, the chart what says slightly weak payrolls, that was the story of it, but the yen carry trade was really the big driver on that day that really shot out this volatility up to those levels. And the stock market was not even down from its peak 10% at that point in time. So that's what's really difficult to explain. Normally, when you have this level of volatility with the VIX, it takes time. The stock market is usually in a deep downturn, as you can see with these other instances in history, and when the VIX has hit these similar levels. So as fast as the volatility came, it hasn't dissipated in 2 days, but it hasn't taken that many days to dissipate back on the downside and be back in the teens now at this level. So, with these major market moves, with these major spikes in volatility with the VIX, there's going to be a lot going on. The next table that we're going to look at in the next page. This particular table, I'm just going to do a quick summary of it. Basically, it's going to look at the VIX spikes that have happened over the course of time since 2008. And for instance, 2008 was kind of an exception. This dates back into the 90s. And what you're looking at is some spikes in the VIX, what's happened in stock market returns when you go and you look out a year. And historically, the stock market returns have been very, very strong, with 2008 was an exception. The next chart on the next page, I think probably gives a little bit better perspective on this. And that is, you're looking at a chart that shows 3-week spikes in the VIX. And that's going to be on the left side, outlining all those periods of time when that occurred. And then on the right side, it's going to show you the associated returns with the stock market when you look out 1 year, 2 year, 3 year, 4 year, 5 year. And the returns in almost all those periods are very, very strong. And while I love this data, and I certainly hope this is how it plays out, I'm a bit hesitant, is this recent VIX spike is so much different than what has happened in history. I mean, again, the stock market usually has incurred a substantial amount of damage on the downside during these big moves in the VIX, and that's absent in this go around. So the outlook could be very strong, but we need to be a little cautious as we look at this data. So how did HCM react to this volatility when that was occurring during that period of time? So number one, we were already overweight equities in our portfolio and have been for quite some time. So we were reviewing the data as it occurred. We had no data or indicators to consider making a change in our equity allocation in that short of a period of time. For clients that were dollar cost averaging, though, into the stock market, so moving dollars at an incremental pace, we moved up those purchases and kind of ramped that up onto that date to make another round of purchases for those investors that were doing that. So as we move on to this last chart on what I'm going to handle here during my segment. So if we look under the hood, the good news is, during the sell-off and during this downturn, it didn't mirror the typical sell-offs where this chart shows that oftentimes you have a substantial amount of stocks that are making new 52-week lows and very few stocks making new 52-week highs. During this downturn, you had very new stock lows, and still there was quite a few stocks that weren't too far away from their high. So the market internals were very good. But again, this may go back to the fact that the downturn was less than 10%. And, given that, I would expect that there wouldn't be too much damage when you look under the hood and what was going on in the market. But guys, I've just been shocked at how quickly the market has recovered. So, Doug, how many days were you telling me that it took for the market to recover back on the upside from what we lost?
I mean, I don't think technically we're all the way back up there, but I mean, 8-9 days.
Yeah.
Realistically, I mean, it's almost like it didn't happen. I mean, to compare it to COVID, I think is a little extreme, but in terms of maybe a mini flash crash or mini dip, it came and went very, very quickly. So I think, as you mentioned before, being max overweight already didn't necessarily leave us a whole lot of room to increase risk, so to speak. But at the same time, when you try to gauge everything that's going on and saying, okay, is this a time to cut risk? I think, when we talk about the tactical process and multiple inputs that we use, I think that helps us make informed decisions as opposed to emotional decisions. And that certainly helped us here for the time being, assuming this doesn't turn into anything more significant. But, I think going forward, the big theme now that this is over with, and one that we've talked about for a while, is going to be rates and the Fed and kind of what the economy is going to do next, so to speak. So you've heard the phrase soft landing, versus hard landing. So, really that means, is the economy going to maintain its current growth or decelerate slightly? Or are we going to get a hard landing and ultimately end up in a recession in a worst case scenario? I think there's data points on each side to make the case, but let's go through some of these, and then in the next few charts, we'll kind of dive into some of these points a little bit more in more detail. So on the soft landing side, you have strong housing equity, relatively low debt there. I mean, obviously mortgage rates are up, but I think if you look at the average interest rate for outstanding mortgages, it is still in the low to mid 3 level. So yes, you have people who have had to take on some higher rate mortgages, but for the most part, most of that debt remains at pretty manageable levels. The unemployment rate is rising, but the rate is low, and there's still plenty of job openings. We'll look at that here shortly. You have real-time inflation that's under 2%, so certainly moving in the right direction. The yield curve inversion, there's been a lot of made about that, but that's given companies kind of time to strengthen their balance sheet, so to speak. So the corporate world, I think, is in very good shape in terms of their balance sheets. Banks have low leverage. The U.S. relatively immune to geopolitics. I mean, that's the case now. I don't know that is a kind of a fact in every certain circumstance, but certainly it's been recently. And then we've heard a lot about this AI revolution and how that's going to benefit the U.S. I think there's still some momentum there, but I think there's people who are starting to question how feasible it is for AI to truly revolutionize the entire economy in such a short window. So I think that's a little bit yet to be seen. So now on the hard landing side, or the recession side, so the Fed has kept rates too high, and it's going to decrease future growth and increase uncertainty. There's many people that are arguing that lagged effect of higher rates hasn't taken hold yet, and we're going to see that sooner rather than later. The yield curve inversion and the SAM rule, I don't necessarily want to get into the SAM rule here, but it's really just a measure of the unemployment rate going above a 12-month moving average, and historically has been pretty accurate at predicting recessions. That has actually taken place just recently here with the latest print. Ironically, Claudia Sam, the person who came up with this rule, was interviewed not long after it triggered, kind of saying, this time is different, and I wouldn't buy into it. So nevertheless, there is some increase in the unemployment rate. We'll look at consumer savings depleted a little bit. Obviously, there was an excess from COVID cash, and that's worked down a little bit. You've got $9 trillion of deficits over 4 years. That's obviously put the fiscal situation under a little bit of bind. You've got high taxes, or should I say 36% of income taxes is going to pay interest on the national debt right now. And then with the increase in interest rates, obviously, there's been some concern about real estate and regional banking. So I think there's cases to be made on both sides. But let's look at kind of the important points here. So this is a chart that shows historically what the market has done based on the speed of the rate cutting cycle. So what jumps out here is that this first dotted line here would be the first rate cut. So we'll call this month 0. So this is the 12 months leading up, 12 months after, and then this goes all the way out to 2 years. What's obvious is that this blue line, which represents a slow easing cycle, or the Fed's ability to not have to drastically cut rates in terms of emergency, is pretty good, and that's what's going to give you the highest rate of return in the market. So when we talk about soft landings, we're hoping that that's what's going to take place, and that the Fed can slowly bring rates down because they don't have to accelerate it in order to react to a crisis, so to speak. Now, when you look at the faster rate of cuts here, historically, that's been a little bit more challenging on the market, at least in the short term. You do get some positive performance over the first, we'll call it 6 months, but then eventually you get into some kind of crisis situation, whether that be, white or the tech bubble blowing up or great financial crisis, but ultimately that kind of leads to a recessionary path. And recessionary path is obviously tougher on the market. But even if you look out 2 years, most of these scenarios are pretty good. So I think when we think short term, yes, there could be some volatility to the downside if the Fed were forced to cut aggressively. But long term, again, over the full market cycle, things are still relatively positive. So what is driving the Fed's decision to leave rates alone or to cut? So really the two things I think they're paying attention to are inflation and employment. Looking at CPI and PPI inflation. PPI is just the producer price index. There's a few different lines on here. I think what we'll pay attention to here really is this total line, this blue line. And you see these other three components, they have, come down pretty drastically since the beginning of the year. And I think you're seeing total CPI as well start to follow that track. So if there's some follow through there, and the Fed feels comfortable that inflation is moving in the right direction, I think that will give them some leeway to say, all right, we can begin the process of moving interest rates a little bit lower. Now, the employment picture is a little bit different. Again, we mentioned the SAM rule earlier. And just yesterday, we had a unique revision to some of the payroll numbers from the past year. So there was an announcement that Bureau of Labor Statistics revised the kind of total number of jobs that had been reported down by about 800,000, which is a really big number over the course of 1 year. I mean, if you look at this chart, it's the second biggest negative payroll revision on record. So it's not, a complete outlier, but it's certainly unique in the sense that, the argument here is that they've misrepresented the job numbers by a pretty significant number. And if the Fed is looking at those numbers and making decisions based off that, how will they look at this and react now going forward? When we look at unemployment rate, this chart goes back to 1980. And what we can see pretty clearly here is that every time there's a spike in interest rate, or excuse me, the unemployment rate, it coincides with the recession. Are we starting to see enough upward movement in this unemployment rate to be concerned? Concern might be a strong word, but I think it certainly gets your attention as you look and see that start to move in the upward trajectory. Now, at the same time, as we mentioned before, the rate still is relatively low based on the last 20 years. But at the same time, it was also low in 2009. It was also low in 2000. So again, this isn't enough to say, all right, batten down the hatches, get defensive and start to worry. It's just one data point, many, but this kind of upward trend in the unemployment rate is certainly something that I think has gotten not only our attention, but other strategists as well. And then when you look at yields, we talked a little bit about the corporate balance sheets being being in pretty good shape here. I know fixed income has been a dirty word for a lot of people since 2022. But it's hard to ignore the fact that if you look at the corporate landscape right now, you can get some very good yields buying investment grade corporate bonds. So this is triple B in green, you have A in blue, double A in orange, and then triple A in purple, which is the highest investment grade quality. And you've got almost 5% on all of these. So understanding that corporations are in good shape and the ability to lock in what are essentially money market yields right now for what may be a longer period of time. Because remember, when the Fed starts to cut rates, those money market rates are going to come down with it. These are some opportunities that we've taken advantage of recently to move cash from maybe a little bit more uncertain outlook to locking in rates for a little bit longer period of time. And Dan's going to touch on that a little bit more here in just a second. And then finally, when we talk about, other data points or when people ask, what would we see and really be concerned that we may be going into recession? Well, another kind of, infallible data point for recession is a very rapid steepening of the yield curve. Okay. So we've heard a lot about, yield curve inversions, and when those become uninverted, then that's almost guaranteeing recession. It's not necessarily when it goes from negative, 10 basis points to zero. It's when you start to see these spreads really accelerate to the upside. So this is the 10-year 3-month treasury spread in orange, and then you have the 10 2-year in purple. And you can see that these red lines, again, with the gray bars matching up with recessionary periods, almost always start below zero and then have rapid steepening. So when I say rapid, meaning anywhere from 200 to 250 to 300 basis points or 2 to 3% difference between these numbers. So to give you some context, right now, both of these are still negative. The 10 3-month is at negative 1.4, and the 10 2-year is at negative 0.17. So this isn't necessarily something that's going to happen overnight. You're not going to wake up and say, oh my gosh, the yield curve's at 3%, the recession's here. What do I do? This is a process over time, but I think as we look at boxes to check off to maybe move into a more defensive posture, we would need to see this rapid acceleration of the inverted yield curve. And while we've seen a little bit of movement, I don't think we've seen the type of acceleration that you would normally associate with recession quite yet. So, from an economic standpoint, the data still looks strong. There's certainly some things now that have caught our attention. But, I think on the whole, we're still not seeing enough data points to say, okay, recession's at the doorstep and we need to do something about it. So Dan, we talked a lot about, the great crashers. I joked the Great Recession of August 5th. We've looked at the economy. So from a current standpoint, market outlook, what can you share with us?
Yeah, absolutely. So as Casey talked about earlier, there was quite a lot of excitement over the last couple of weeks with the yen carry trade and a big VIX unwind that led to an almost 10% pullback in the S&P 500. Now, when I look at things like this, when I see big market moves to the downside, I really try to look to see if any damage has actually been done to the underlying breadth and health of the market. So after this, we're looking at global breadth here. So this chart shows the percent of all global markets over their 50-day moving average, which is a pretty strong 3 to 6 month trend health indicator. And as you can see in the far right of this screen, which was that big pullback we just had, the percentage of global markets dropped to 17% of global markets above their 50-day moving average, and then immediately popped back up to 94%. So you have almost the entire world in a very strong, in a very healthy market. When you see these typical big drops followed by very high spikes, when I see these, and throughout history, I mean, this chart only goes back to 2019, it's odd to say, but typically they mark market bottoms. So when we're looking at this and saying, hey, there was a huge VIX spike, we had 9%, almost 10% pullback in a very short period of time. Was there any damage to the underlying trend of the market? Globally, you can look at this and say the damage for the most part has been pretty much repaired. None of our internal indicators really even showed us anything that said we needed to move off the positioning that we currently have. And a lot of data across the entire market is showing us that whatever damage has been done has pretty much, for the most part, been repaired. So from a breadth perspective, we're looking pretty good. Technically, a lot of stocks are in uptrends. You have many of the sectors in the S&P 500 in uptrends, globally in uptrends. So when you look at this VIX spike, if you would have went on vacation for 2 weeks, you would have come back to the same exact market that you left. So from a breadth perspective, and technically speaking, the market is looking pretty good. We touched a little bit on economics, and now we'll look at the fundamentals of the actual stocks in the market. So this chart shows earnings growth, EPS growth for both small caps and large cap stocks, and breaks them out. Large caps being in blue, small caps being in that pink purple color. So as has dominated for the last year and a half, large cap stock earnings growth has really been driving the market. The S&P 500, especially the top of the S&P 500, have been accounting for a vast majority of the earnings growth, which has been driving the price performance of the S&P 500. Now, not only within the S&P 500, we're starting to see other asset classes on this chart, small caps in pink there, their earnings projections are starting to catch up to and even surpass the S&P 500 earnings growth. Now, large caps are in blue here, and we're looking at 2024 all the way out to the end of 2025, and the S&P 500 earnings are still pretty strong. They're still slightly above their 50-year average for their EPS growth. But if we look at small caps in pink, 2024, towards the end of 2024, you're starting to see them catch up a little bit. And starting in Q2 of 2025, you're starting to see a very significant jump in small cap earnings compared to the S&P 500. So this would actually be, if this played out, small cap earnings really significantly outperforming the S&P 500 earnings. This would be the first time since 2021. So that's a very long time in which large caps have absolutely dominated. So to look at some of these numbers here, so at the end of 2024, if all of these estimates for earnings growth continue and don't get revised down, you have large caps earning growth at 13.9%, and small caps for 2025 are going to be 22.2%. That's what they're estimated to be. Now, that's a very significant jump, and we've seen small cap earnings be extremely volatile. But if that plays out, you would expect small caps to have a little bit of footing underneath them to perform pretty well against the S&P 500. Now, that's not the only story that's going on this year. We have rate cuts coming up, and we have to see how small caps react to rate cuts. And surprisingly, the Russell 2000 tends to do pretty well in an environment where there are rate cuts. Now, the average gain in the Russell 2000, which is the small cap index, is 11.4% over the first year after a rate cut. That's a pretty strong number. We like that number. But there are two different stories here. There is a soft landing story and a recessionary story. So in an environment where the Fed is cutting rates, alluding a little bit to Doug's fast cycle, small caps definitely struggle a little bit. We saw that chart where the S&P 500 in a rate cut environment still 12 to 24 months out does pretty solid. Small caps are kind of in that same story, not quite as well as the S&P 500. But in an environment where no recession follows over 12 months, and we're in that slow cycle of rate cuts, small caps on average return 15%, which is a very good number that we would like to have. Now, with small caps, their earnings projections are very volatile, and we have to be absolutely positive that we are in a soft landing scenario to add small caps. So it's definitely something that we are absolutely watching, and there could be potential to add small caps to the portfolio. Now, going over to the fixed income side, we've had quite a while where money market rates have been over 5%, and a lot of investors have been pouring into money market rates to collect that 5%, and it's been a very good trade. It's bank account cash, and getting 5% is fantastic. But with the rate cuts that are projected in September and further on, that money market interest rate is going to fall. And you're starting to see on this chart the T-bills, which are shorter duration treasuries and typically are in money markets, are in the dark blue there. A lot of investors are starting to finally move some of that money out of money markets because those rate cuts are going to lower those money market rates, and starting to extend out their duration and adding 2 to 10-year bonds to really lock in those yields. This is something we've been doing over the last year with some of our money market. I think we had about 30% of our fixed income was in money market. Now we're close to about 10%. we've been going in and locking in those treasuries, and a lot of investors have been doing the same thing. We really want to make sure that we are getting those higher rates for a longer duration as the money market rates start falling. Now, what happens to bonds when the Fed comes out and cuts rates? So these are the average returns following the first rate cut from the Fed. And it breaks out 6 months, 1 year, 3 year. And as you can see, we have the 3-month treasury there in gray, the aggregate bond there in the light blue, and longer duration treasuries in the dark blue. Now, we know longer duration treasuries benefit more so than shorter duration treasuries when rates are falling. So 6 months out, your shorter term treasuries are up 3.5 compared to your longer duration treasuries at 5.5. 1 year, that story gets even larger. The shorter duration treasuries are returning 7.2, which is still a fantastic number, but your longer duration treasuries are yielding or returning 12.7%. So we have been doing this over the last year, locking in those longer rates with defined maturity bonds. But it is definitely something that we may be moving even more cash over to increase our duration as the Fed comes out and starts beginning the cutting cycle. And then Doug is going to talk to us a little bit about how the portfolios are positioned today.
Yeah, so it's been maybe 2 presentations since we've done a positioning slide. So just kind of giving a general idea of where the portfolios sit today from a tactical perspective. So we remain overweight equities, and I would say that overweight probably is predominantly in U.S. large cap. So that's both U.S. against international, and then I'd say large cap versus small. We do own some international still, we do own some small cap still, but the majority of that positioning is going to be in U.S. large cap equities. Dan talked a lot about small cap today and kind of the scenario that could play out in order for us to increase some of those other areas. But right now, we are maintaining kind of the status quo with what we've had. We're still holding a small cash balance. I mean, when I say small, that can mean different things to different people. But I say small because it was much higher, probably 6 to 8 months ago. And as Dan mentioned, we've been using that some of those opportunities in yields in order to kind of lock in rates for longer periods of time with the expectation that the Fed is going to cut rates. So we recently increased duration. Part of that was moving one of our floating rate bond positions into some longer dated treasuries. That was really in a reaction, again, to potential Fed rate cuts, but also a little bit of an insurance policy as we saw some of the economic data waver slightly. Again, we're not calling for recession. We're not saying recession is at the door. But as that last slide showed, the return after the first Fed rate cut for longer duration treasuries is pretty good. And we want to make sure that our fixed income is positioned well to take advantage of that. And then finally, I think the economy and the Fed is going to determine our next moves for cash and for stocks. I mean, at some point we will have to take our equity overweight off and take it back to neutral. Hopefully it won't have to go underweight. But most of the time you're not going to stay overweight forever. We love to, because that would mean everything's, going pretty well. But depending on those two things, I think will be the driver of our next consideration for a tactical move, so to speak. And then the last slide, we've had a few of these. I know we included one the last time, and I think it's more because I think when markets are performing exceptionally well, and they have been for the last 2 years, I think sometimes we can lose our compass of expectations, so to speak, and start to believe things that maybe in the moment could be true, but historically are not. So I thought this was a good little chart, or not even a chart, just a kind of poem, if you want to call it. I don't even know, but we'll go ahead. The secret is there is no secret. It's consistency over intensity, progress over perfection, fundamentals over fads, over and over again. And I think that's important to remember as you're looking to build wealth. Wealth is built over multiple years and not necessarily over multiple months, even though we feel like when we get caught up in the moment, this AI revolution that, we're missing an opportunity to somehow be able to retire 10 years earlier than we thought we would. Unfortunately, that's not usually the case. And that's not how you're successful in investing over the long term. So just kind of a little reminder there on how we view things and how we want to make sure our expectations are in line. I think I saw a question come through, so let me pull this up. So this is, do we believe the theory that holding energy stocks prior to the election is dead money? Is there an election? I've not heard anything about that. But no, I mean, I'll be honest, I have not necessarily heard that theory specifically. I think there's still a lot to be kind of played out for this election. We've had a lot of clients asking about it. We may do an election specific webinar here coming up. We're still waiting on specifics from, policy plans on both sides. So I won't, try not to get into any of the specifics of that. But I think that each side of the aisle has very different views on how they want to deal with the economy. So based on the projections of who's elected, I would say certain sectors would be more favorable than others. I think from just a purely objective perspective, I think the Democrats want a more clean energy, kind of green policy, so to speak, and that could be, trying to speed up the timeline of transitioning things like oil and gas into cleaner production. Whereas I think the Republicans are maybe not as anxious to get that done. It's hard to answer that, not knowing who's going to actually win and what the makeup of Congress is going to look like. Because again, I mean, we focus all our time on the presidency, but bills still have to go through Congress. And if there is not a straight line Democrat or straight line Republican House Senate presidency, there's certainly not going to be the capability to just shove things through without some level of pushback. I guess, Casey, Dan, do you have anything to add to that?
So I have to say, I don't know anything specifically about this theory, but you mentioned with, let's just say, clean energy. So leading up into the prior election, if you rewind 4 years ago and what was happening, there was a period of time where the market was doing well on the basis and thought that Democrats were, if they win, that clean energy stocks then may do well based upon what was said in the course of by candidates leading up into to the election. But then we find what oftentimes is said and what gets implemented, which actually comes in policy, is vastly different. And clean energy stocks during the last 4 years really struggled and not performed well. And that did not align with, I think, what expectations were. So that's been a question in a lot of meetings that people have asked is, based upon what candidates are saying, do we need to consider making any moves? And right now, I think we're a little hesitant to do that, again, based on history. I'll give you another example of this. Back in the early 90s, when Clinton was in office, and at that point in time, he had asked Hillary to kind of head up reform in the medical industry. And at that point in time, that seemed like that could be very negative to a number of drug makers and other potential companies in the healthcare sector. Well, lo and behold, what actually was expressed and what was done wasn't a lot. And during that period of time when he was in office, sector had some of the best performance for healthcare stocks. So, there's very much, it's very frustrating. I wish that somebody would actually keep a tally of what candidates say and what they actually get implemented. And so we just have to wait. There's awful lot going on economic policy talk, and we just need to wait until I think we get into next year. And as you said, Doug, really see where if you've got control by a candidate, then certainly that could be a reason for some change, and certainly that may mean we need to make some adjustments to the portfolio.
Yeah. And again, I think as some things become more clear, we will probably have some more election focused material coming out. I mean, there's been some questions about this unrealized capital gains tax that I've seen, other things along those lines. But again, the details on that are not etched in stone yet. It's more just headlines. But I think once we get some more clarity on that, we'll certainly be able to start to talk about it a little bit more. So that's the only question we have for today. So Casey, I think we're ready to go.
Well, thank you very much for attending our webinar today. Certainly has been an interesting couple weeks here in the market. Unfortunately, things are back on a good path, but as we know, market volatility doesn't go away. So in time, if you'd like to talk about your portfolio, how we deal with market sell-offs and what that means, if you're in retirement, we need to supply cash flow. We're glad to talk about a safety net and what we implement in clients' portfolios and how we maneuver around volatility to ensure that we're not selling assets at depressed prices to fund cash flow needs. So we're certainly glad to talk to you about your specific plans. So don't hesitate to reach out to your advisor. And if there's a family member or friend that we can help, please don't hesitate to provide an introduction. We would be honored to help. Thank you and have a great evening.